Imagine you're on a plane. The flight is long, turbulent, and the pilot keeps adding weight, ignoring the warnings. This is the situation of the global economy in 2026. While the world is distracted, something dangerous is happening behind the scenes. A silent scream echoes: global debt. In 2026, the combined debt of governments, corporations, and households reached a frightening level: 310% of global GDP. For every dollar of wealth produced, we owe more than 3. It's not an abstract number, it's a gravitational force pulling down your purchasing power, your future, and the stability of the financial system. It's the mortgage on your house, your car loan, your college financing, your parents' retirement, all interconnected. But what does this mean? Who are the creditors? Who are the debtors? And most importantly, who's going to pay this bill? In the next few minutes, we'll unravel the truth behind this mountain of debt. We'll expose the countries and sectors on the brink of collapse, and crucially, show how this silent crisis already affects your pocket and what you can do to protect yourself. This is not a story of fear, but of awareness and preparation. At Finance Deciphered, we believe that knowledge is your greatest defense against future uncertainty. Get ready for a journey through the corridors of financial power, where today's decisions shape your tomorrow. A journey that can change the way you see money and the world. To understand the magnitude of the problem, we first need to dissect this three-headed monster called global debt. It's a complex tangle that includes 3 major categories. When this debt grows out of control, it can become an unsustainable burden requiring an ever-increasing portion of the budget to be allocated just to paying interest, choking essential investments and economic growth. The situation worsens when governments resort to printing money to monetize their debts, which invariably leads to inflation, eroding the population's purchasing power and increasing the cost of living for the indebted. Second, corporate debt. It's what companies owe. In a low interest rate environment, many became excessively indebted. Now, with the rise in interest rates in 2025 and 2026, this cheap debt has become a heavy burden. Companies with leveraged balance sheets face much higher financing costs, which can lead to cuts, layoffs, bankruptcies, and ultimately a widespread economic slowdown. The real estate sector, for example, is particularly vulnerable, with many builders and developers operating with tight margins and relying on short-term financing. And third, household debt, mortgages, student loans, vehicle financing, credit cards. This is the debt that most affects the average citizen. When interest rates rise, the cost of living increases, and families' ability to pay their debts is severely compromised. A household debt crisis can lead to foreclosures, widespread default, and an abrupt drop in consumption, which is the engine of many economies. The situation is even more precarious for low-income families, who already allocate a larger portion of their income to debt service. Historically, debt is not inherently bad. It can be a tool for growth. But what we see in 2026 is the proliferation of zombie debt. Debt that doesn't generate productive growth, but merely sustains inefficient entities or finances excessive consumption. The cost of this debt is exploding. Interest rates, once low, now make debt service unsustainable for many, becoming one of the biggest risks to financial stability. We're at a turning point where debt, instead of being an engine, has become a brake on the global economy. Each tick represents an increase in interest, a new loan to pay off the old one, a new layer of risk added to an already fragile system. You're here because you seek the truth. The simplistic narratives of traditional media hide the complexity of the financial world. At Finance Deciphered, our mission is to decipher what's really happening, without filters, and give you the tools to navigate these turbulent times. If you value in-depth analyses that prepare you for future challenges, subscribe to the channel right now. Turn on notifications so you don't miss our next videos. Join our community of critical thinkers. Let's start with the biggest player, the United States. American public debt is not only the largest in the world, exceeding $34 trillion, but it's growing at an alarming rate due to chronic fiscal deficits. Each year, the American government spends more than it collects, and the difference is covered with more debt. This trajectory is unsustainable in the long term. For decades, the world accepted this debt because the dollar is the global reserve currency. This privileged position allowed the U.S. to finance its spending at lower costs and with constant demand for its bonds. But what if this confidence erodes? The risk of a U.S. sovereign default is no longer a fantasy. A default, even a technical one, would have catastrophic consequences, shaking markets and devaluing the dollar in unprecedented ways. U.S. credibility as a debt issuer would be irreparably damaged, and the impact would extend to all dollar-denominated assets. Imagine the scenario. The dollar loses its value. What happens to the price of gasoline, of imported products, of your savings? An American soft default, where debt is paid with a currency devalued by inflation, is a real and frightening possibility. The impact would be felt in every corner of the planet, including Brazil, where the economy is heavily influenced by the dollar. Dollar devaluation could lead to massive imported inflation. increasing the cost of living for all Brazilians and eroding the purchasing power of the local currency. With rising interest rates, the cost of servicing this debt becomes an increasingly heavier burden on the federal budget, diverting resources from productive investments. The IMF and other institutions warn of the need for fiscal adjustment in the U.S. to avoid a crisis. Inaction can lead to a scenario where confidence evaporates and the wounded giant may topple, dragging the world economy down. Financial empires don't fall all at once, but through unsustainable decisions that erode confidence. The loss of global reserve currency status for the dollar, although an extreme scenario, would have profound geopolitical and economic implications, redefining the world order and balance of power. If the U.S. is the wounded giant, emerging markets are the most vulnerable. Countries like Argentina, Egypt, Pakistan, and nations in Africa and Southeast Asia are on the front line. They became heavily indebted in dollars when interest rates were low. This debt was used to finance infrastructure projects, social programs, and in some cases to cover chronic budget deficits. Now, with a strong dollar and high interest rates, the cost of rolling this debt has become prohibitive. Some countries are allocating an alarming portion of their revenues just to pay interest, like the 14.8% cited in reports. This means less money for health, education, and infrastructure, less money for the future of their population. It's a vicious cycle where money for development is drained to pay foreign creditors, perpetuating dependency and poverty. The situation is aggravated by capital flight, where foreign investors withdraw their resources in search of safer markets, further pressuring local currencies and increasing the cost of debt. What happens when they can no longer pay? A sovereign default. This leads to loss of access to capital, currency devaluation, galloping inflation, and deep recession. Argentina, for example, has a history of defaults with devastating consequences. A default in one country can trigger a domino effect, spreading panic. Investors withdraw their capital, local currencies plummet, inflation explodes, and poverty deepens. In 2026, with current debt levels, the threat is even more severe. Political and social instability is an almost inevitable consequence of economic crises of this magnitude, with protests, civil unrest, and abrupt government changes. The interconnection of the global economy means that a crisis in an emerging market can affect supply chains, commodity prices, and investor confidence worldwide, including Brazil. Volatility in emerging markets can lead to capital flight from our own country, impacting the exchange rate, domestic inflation, and the government's ability to finance its programs. The debt of a distant country can indeed knock on your door, whether through the increase in the cost of living, job losses, or the devaluation of your assets. Brazil's external debt crisis in the 80s, for example, is a vivid reminder of how external vulnerability can paralyze an economy for decades. The complexity of global debt is immense. I want to know yours. Do you think the current financial system with this mountain of debt can withstand another decade without a major event? Or are we heading toward an inevitable reckoning? What's your vision for the future of the global economy? Leave your comment below. Your perspective is valuable and enriches our collective analysis. At Finance Deciphered, we value constructive debate. Your voice matters, and your participation is fundamental so we can continue to unravel these complex themes together. Faced with this time bomb, governments and central banks seek solutions. But these solutions come with a hidden cost and can be as disruptive to your financial freedom as the crisis itself. One of the most discussed is the Great Financial Reset, a profound restructuring of the global monetary system. This can manifest in several forms. They would give governments unprecedented control over money. Imagine a scenario where the government can program your money to expire, or to be spent only on certain types of products. Financial privacy would be drastically reduced. Every transaction could be monitored, every expense tracked. It's the total digitization of monetary control, with profound implications for individual and economic freedom. Additionally, the implementation of CBDCs can lead to greater centralization of financial power, with central banks having the ability to impose negative interest rates directly on citizens' accounts, encouraging consumption and discouraging savings, which can have profound effects on the economy and individual freedom. China, for example, is already advancing rapidly with its digital yuan, and other countries are actively exploring this technology. Second, financial repression. A subtle strategy where interest rates are kept artificially low, often below inflation, allowing inflation to erode the real value of debt. It's a form of silent theft of savers' purchasing power, who see their savings lose value while government debt decreases in real terms. It's a tool used to deflate mountains of debt without an explicit default, transferring wealth from savers to debtors, mainly the government. Financial repression can also manifest through capital controls, restrictions on moving money out of the country, or wealth taxes, all aimed at keeping the debt system functioning and avoiding a total collapse. Third, debt forgiveness, or jubilee. While it sounds like relief, it has devastating consequences for creditors and for trust in the system. who wins and who loses. Generally, governments and big banks benefit, while the average citizen who saved and worked sees their purchasing power and savings eroded. History shows that these resets are rarely fair and always favor those in power, leaving the most vulnerable at the mercy of political decisions. Large-scale debt forgiveness can destroy trust in contracts and financial institutions, leading to an even greater collapse of the system and widespread distrust in markets. The moral hazard that future debts will also be forgiven can encourage even more irresponsible borrowing. These solutions are not neutral. They redistribute wealth, change the rules of the game, and often pave the way for the next crisis. Debt doesn't disappear. It's transferred, restructured, or inflated away. And you, as a citizen and investor, need to be aware of these dynamics so you won't be caught by surprise. Faced with such an uncertain scenario and solutions that can be more harmful than the disease itself, how can you protect your assets and your family? There are no easy answers, but there are principles and strategies that can guide you and strengthen your position, turning uncertainty into opportunity. First, diversification. Don't put all your eggs in one basket. Consider assets that historically act as safe havens in times of crisis and currency devaluation, such as gold and silver. They are currencies that have withstood the test of time for millennia, maintaining their intrinsic value. They offer robust protection against the devaluation of fiat currencies and the instability of the traditional financial system. Think of them as insurance for your purchasing power, a store of value that transcends government policies. Additionally, diversification in precious metals can be a way to partially detach from the traditional financial system, which is increasingly interconnected and vulnerable to systemic shocks. Physical ownership of gold and silver, for example, offers an additional layer of security against the bankruptcy of financial institutions or the imposition of capital controls. It's a way to keep part of your assets out of the direct reach of governments and central banks, providing a layer of security and financial sovereignty. Second, explore decentralized digital assets like Bitcoin. For many, it represents a revolutionary alternative to the traditional financial system, with its limited supply and its nature immune to money printing by central banks. Bitcoin is a scarce, global, and censorship-resistant asset. However, it's crucial to remember that volatility is high, and in-depth research, understanding of the technology, and a long-term investment strategy are fundamental before any allocation. It can be protection against inflation and loss of financial privacy. Beyond Bitcoin, other cryptocurrencies with solid fundamentals and real use cases, such as Ethereum and privacy coins, can complement a diversification strategy, offering different risk and reward profiles. The key is to understand the underlying technology and the purpose of each digital asset before investing, and never invest more than you can afford to lose. Self-custody of crypto assets is also an important point for those seeking financial sovereignty. Third, invest in productive assets, solid companies with strong balance sheets that generate real value, real estate that generates passive income, or even your own business. Assets that generate real value, regardless of currency fluctuations or government policies, are a safer long-term bet. They are the foundation of real wealth, not just paper promises. This includes stocks of companies with lasting competitive advantages, well-located real estate in growing markets, and investments in education and skills that increase your ability to generate income. The focus should be on companies that produce essential goods and services, that have low debt, and that are able to pass on costs in an inflationary environment, protecting their profit margins and, consequently, the value of your investments. And finally, consider geographic diversification. Having part of your assets in different jurisdictions, currencies, and legal systems can offer an extra layer of protection against localized crises, disastrous economic policies, or confiscations. Financial freedom lies in your ability to choose where and how you allocate your capital, minimizing dependence on a single system or government. It's about having options and control in an increasingly unpredictable world, ensuring you're not at the mercy of a single political or economic decision. This can involve opening bank accounts in other countries, acquiring properties in international markets, or investing in companies listed on foreign stock exchanges. Geographic diversification is not just about where your money is, but also about diversifying political and regulatory risks. The search for jurisdictions with greater economic freedom and less state intervention can be a smart strategy to protect your assets and ensure your long-term financial freedom. The global debt time bomb is not a future threat. It has already been activated. The ticks are the rising interest rates, unsustainable deficits, persistent inflation, and the silent erosion of your purchasing power. Ignoring these signs is like ignoring the fire alarm while your house burns, but you don't have to be a passive victim. By understanding the complex forces that shape our financial world, you gain the power to adapt, to protect yourself, and even to prosper amid uncertainty. Knowledge is your most valuable compass in this stormy sea, and informed action is your lifeboat. Don't wait for governments or central banks to solve the problem for you. The responsibility to protect your financial future is yours, and to keep navigating with us to unravel the next chapters of this global economic saga and arm yourself with the knowledge necessary to protect your future. Subscribe to Finance Deciphered. Join us next week when we'll dive into an equally explosive and crucial topic for your understanding of global power, the secret alliance that wants to overthrow the petrodollar. You can't miss this analysis that will redefine your understanding of global power and future reserve currencies, and how this can directly impact your daily life.